The bull call spread gives you a defined risk way to profit when a stock rises. The bear put spread is the exact mirror, a defined risk way to profit when a stock falls. Instead of buying a lower strike call and selling a higher strike call, you buy a higher strike put and sell a lower strike put. Same logic, same structure, opposite direction. The result is the same. You reduce your entry cost by selling one leg to partially fund the other. You lower your break-even compared to buying a single put outright, and your maximum loss is capped at the net debit you pay. In this video, I will show you how to build a bear put spread on Apple, walk through the exact numbers on the Tiger Brokers options chain, and cover the 3 scenarios that determine your outcome so you understand precisely what needs to happen for this trade to pay. A bear put spread is a debit spread with 2 legs on the same underlying and the same expiry. Leg 1. Buy a put at a higher strike. This is your directional bet. You own the right to sell the stock at that price. If the stock falls below this strike, your put gains value dollar for dollar below the strike price. Leg 2. Sell a put at a lower strike. This is your cost reduction. You give up the profit below this lower strike in exchange for a premium that directly offsets the cost of leg 1. Because you pay more for the higher strike put than you collect for the lower strike put, you pay a net debit to enter. That net debit is your maximum loss. Your maximum profit is the spread with minus the debit paid. Both numbers are defined the moment you enter, before the stock moves a single cent in either direction. Why not just buy a single put? A single put gives you uncapped downside profit but costs significantly more, which raises your break-even and reduces your probability of finishing profitable. Buying a put on Apple at 180 when the stock is at 182.50 costs $4.50 for $150 per contract. Break-even at expiry, $175.50. Apple needs to fall $7 just to reach break-even. The bear put spread solves this. By selling the lower strike put at 170, you collect $1.50, reducing your net cost to $3. Break-even drops to $177. Apple needs to fall only $5.50 to break even. Same directional bet. 33% less capital at risk. Lower break-even. Higher probability of profit. You give up gains below 170, but for a moderate, defined target move, that trade-off is almost always worth making. 2 legs, 1 bearish position. Leg 1, buy the higher strike put. This is your core bearish exposure. If Apple falls below this strike at expiry, your put has intrinsic value, $1 of value for every dollar the stock falls below the strike. Theta works against this leg. Time decay reduces its value every day the stock does not move. Leg 2. Sell the lower strike put. This caps your maximum profit at the lower strike, but immediately reduces your entry cost. The premium you collect from selling this put offsets a portion of what you paid for leg 1. The sold put's theta works in your favor. It decays toward 0, and you keep the premium as it loses value. Net effect, a directional bearish trade with a lower entry cost, a higher probability break-even, and fully defined risk on both sides. No naked exposure. No margin requirement beyond the spread width. Apple is trading at $182.50. You are moderately bearish. You expect Apple to pull back toward the 170 range over the next 45 days, perhaps due to elevated valuations, weakening tech sentiment, or a broader market correction. A single long put at the 180 strike costs $4.50 for $150 per contract. Instead, you build the bear put spread. Buy the 180 put at $4.50, sell the 170 put at $1.50. Net debit, $300 per contract. Maximum profit, $10 with minus $3 debit equals $700 per contract. Maximum loss, $3. The debit paid, $300. Break even at expiry, 180 minus 3 equals $177. Apple needs to fall $5.50 from its current price of $182.50 to reach break even. That is a 3% move to the downside. Maximum profit is $700 per contract. You achieve this when Apple closes at or below 170 at expiry. At 170, the long 180 put is worth $10 intrinsic value. The short 170 put expires worthless. Spread value, $10. Net result after deducting the $3 debit, $7, 233% return on the capital at risk. Maximum loss is $3, $300 per contract. You lose the full debit when Apple closes at or above 180 at expiry. Both puts expire worthless and you absorb the $3 cost. Compare this to the single long put. Maximum loss of 450, 50% more at risk, with a lower probability break-even. Break-even at expiry, $177. Apple must close below 177 for the trade to be profitable at expiry. Any close below 177 and above 170 produces a partial profit between $0 and $700. The profit and loss diagram for the bear put spread at expiry. Horizontal axis, Apple's price at expiry. Vertical axis, profit or loss in dollars. Starting from the right, above 180, both puts expire worthless and you lose the full $3 debit, a flat loss floor at negative $300. At 180, maximum loss. Moving left below 180, the spread begins gaining value linearly. Every dollar Apple falls adds $1 of value to the spread. At 177, you cross zero, break even. Below 177, the trade is profitable. As Apple approaches 170, profit ramps toward the maximum. At 170 and below, the spread reaches its full $10 width and your profit is locked at $700. The maximum is capped because the short 170 put begins offsetting further gains. The shape, a flat loss zone on the right, a rising ramp between the strikes, and a flat profit ceiling on the left. The mirror image of the bull call spread diagram. On Tiger Brokers, navigate to the Apple options chain and select the 45-day expiry. Go to the put side of the chain. At the 180 strike, bid 430, ask 470, mid-price 450. This is leg 1, buy to open, 1 contract. At the 170 strike, bid 130, ask 170, mid-price 150. This is leg 2, sell to open, 1 contract. Execute both legs as a spread order. In Tiger, open the spread order ticket, select bear put spread, enter the 180 and 170 strikes, and enter a limit price of $3 debit. The platform displays your net debit, maximum profit, maximum loss, and break even automatically. Always use a limit order on spread entries, never a market order on two-legged positions. Apple options are highly liquid at major strikes. A fill between 290 and 310 is realistic on most trading days when entering near mid-price on both legs. Scenario 1. Apple drops to your target. 45 days later, Apple falls to $174, a moderate $8.50 decline from the entry price. Your long 180 put is worth $6 intrinsic value. It is $6 in the money. Your short 170 put expires worthless. Apple has not fallen to 170. Spread value at expiry, $6. You paid $3. Profit, 6 minus 3 equals $3, $300 per contract, a 100% return on the debit paid. This is the sweet spot for bear put spreads, a moderate, realistic decline that does not need to reach maximum profit to be highly profitable. Apple fell $8.50. You risked $300 and returned $300 in profit. The spread required no forecast of a crash, just a moderate, disciplined directional move consistent with the prevailing market conditions at entry. Scenario 2. Apple drops sharply beyond the lower strike. Apple reports a significant earnings miss and falls to $160, $10 below your lower short strike of 170. Your long 180 put is worth $20 intrinsic value. Your short 170 put is worth $10. You owe this to the buyer. Spread value, 20 minus 10 equals $10, the maximum possible. You paid $3. Profit, 10 minus 3 equals $7, $700 per contract, a 233% return on risk. Maximum profit achieved. Apple crashed $22.50. You captured the full spread width. The trade was designed for a moderate move, but delivered the maximum outcome. Critically, the short 170 put prevented you from capturing the full $20 profit on the long put alone, but it also reduced your initial cost by $150, which is what allowed you to take the trade with only $300 at risk. Scenario 3. Apple stays flat or rises. Apple rises to $187.50 over the 45-day window, moving in the wrong direction. Both puts expire worthless. Your long 180 put, Apple is above 180. So it expires with no intrinsic value. Your short 170 put, also worthless. Loss, $3, $300, the full debit paid. The position closes automatically at expiry with no action required. No margin call, no escalating loss, no open risk beyond what was known at entry. Compare to a single long put. If you had bought the 180 put at 450, the same scenario produces a 450 loss for $150, 50% more than the spread. The bear put spread trader absorbs 150 less on the wrong outcome. Over multiple trades across a full year, the capital preserved on losing trades is what separates consistently profitable options traders from those who chase single-leg premium. Bear put spread versus single long put. When does each win? The spread wins on a moderate, defined move. If Apple falls from $182.50 to $174, a moderate $8.50 decline, the single 180 put produces a profit of $150 on a $450 investment, 33%. The bear put spread on the same move produces a profit of $3 on a $3 investment, 100%. Same underlying, same move, same direction. The spread wins decisively on return on risk for moderate moves. The single put wins on a large crash beyond the lower strike. If Apple collapses to 150, the single 180 put returns $27 on 450 risk, 600%. The spread is capped at $7. Choose the spread when your price target falls within the spread width and capital efficiency matters. Choose the single put when you expect a severe crash and want uncapped downside profit with no upper cap on gains. For conditions where the bear put spread is the correct tool. 1. You are moderately bearish. You expect a defined decline to a specific price level, not a crash to zero. 2. Implied volatility is elevated, put premiums are expensive, and selling the lower strike put significantly reduces your cost of entry. 3. You have a specific downside target. You know where you think the stock will fall to, and you use that as the short put strike. 4. Capital efficiency matters. You want bearish exposure without committing the full premium of a single long put. The best underlyings are liquid large-cap stocks with tight bid-ask spreads. AAPL, NVDA, MSFT, SPY, QQQ. Avoid bear put spreads in low volatility environments where put premiums are depressed. The credit from the short leg will be minimal and the cost reduction advantage disappears. The bear put spread is a precision tool for measured, defined bearish moves, not for crash speculation. Complete bear put spread on one page. Underlying, Apple at $182.50. Strategy, bear put spread, moderately bearish, defined risk. Leg 1, buy 1 Apple 180 put, 45 DTE, at $4.50. Leg 2, sell 1 Apple 170 put, 45 DTE, at $1.50. Net debit, $3, $300 per contract. Spread width, $10. Maximum profit, $7, $700, when Apple closes at or below 170 at expiry. Maximum loss, $3, $300, when Apple closes at or above 180. Break even at expiry, $177. Risk reward, 233% maximum return on risk. Apple needs to fall 3% to reach break even. Downside target for maximum profit, 170 or below. Trade management. Consider closing at 80% of maximum profit if reached before expiry. That is 560 credit to close. Do not hold to expiry chasing the final dollar of a spread trade. Here is what you now know. 1. The bear put spread buys a higher strike put and sells a lower strike put on the same expiry, paying a net debit, the exact mirror of the bull call spread. 2. Maximum loss is the debit paid. Maximum profit is spread with minus debit, both known before entry. 3. The spread outperforms a single long put on return on risk for moderate, defined bearish moves within the spread width. 4. Use it when you are moderately bearish, when implied volatility is elevated, when you have a specific price target, or when capital efficiency matters more than unlimited downside profit. 5. Always use limit orders on spread entries. Know your break even before you enter, and manage early at 80% of maximum profit. You now have a defined risk tool for every direction. Bullish with the bull call spread, bearish with the bear put spread, neutral with the iron condor, and range-bound income with the wheel. Series 2 continues with the straddle and the strangle, the strategies that profit from large moves in either direction, video 16.